What is an ETF? Think of an ETF, or exchange-traded fund, as a basket. This basket holds a variety of investments like stocks, bonds, or other assets. When you buy shares of an ETF, you're buying a tiny piece of that basket. Unlike buying individual stocks directly, ETFs give you a slice of multiple stocks, all bundled together. This makes it easier for folks like you and me to invest without having to pick each stock ourselves. It's like choosing a whole medley instead of just one fruit at a store. How do ETFs work? So, how do these nifty bundles actually operate? Well, ETFs trade on the stock market, just like any regular stock. You can buy and sell shares of an ETF through a brokerage account throughout the trading day. This flexibility is one reason why investors, from beginners to seasoned pros, find ETFs appealing. Inside each ETF, there are usually a specific set of investments aiming to track the performance of a particular index. For instance, an ETF might focus on tracking the S&P 500 index. This means if you invest in this ETF, your returns will mimic the index it follows. Another handy feature of ETFs is their versatility. They can cover a wide range of asset classes, from stocks and bonds to commodities and even currencies. This variety allows investors to diversify their portfolios easily. ETFs also offer transparency. You can see exactly what the ETF holds at any given time, so you know where your money is going. They often have lower fees than mutual funds, making them a cost-effective choice for many investors. Flexibility, diversification, and cost-effectiveness. These are the hallmarks of ETFs. Whether you're a novice eager to dip your toes into the investing world or someone looking to beef up a portfolio, ETFs offer a straightforward path to achieving your investment goals. The next time you think about investing, consider whether an ETF might be the blend of simplicity and diversity you need. Types of ETFs you should know about. Stock ETFs explain. Stock ETFs, or exchange-traded funds, focus on stocks. Imagine a basket filled with various companies' shares. When you invest in a stock ETF, you're buying a slice of that basket. It's like enjoying a fruit salad instead of one type of fruit. Stock ETFs offer diversity without needing to pick and manage stocks individually. They track popular indices like the S&P 500, meaning you own a bit of everything within that index, from Apple to Microsoft. This setup makes them appealing to beginners and experts alike. The goal? To earn returns as the market grows. Exploring bond ETFs. Bond ETFs work a bit like stock ETFs, but instead of holding stocks, they contain bonds or debts. Think of them as a group of loans you hold a piece of. They mostly involve government or corporate bonds. Why invest in bonds? They generally offer stable returns and lower risk compared to stocks. Bond ETFs can pay you regular interest, making them attractive if you seek steady income. So, if you're aiming for income and reduced risk, adding bond ETFs to your portfolio could be smart. Understanding commodity ETFs. Commodity ETFs are all about raw materials. They let you invest in products like gold, oil, or wheat without needing to purchase the physical commodity. Picture it as buying shares in a farm, without owning land or food. Such ETFs are a way to speculate on the price movements of these resources. They can protect against inflation because commodity prices often rise when everything else does. But keep in mind, they can also be volatile, depending on market conditions. If you want to add a bit of spice to your investment portfolio with the potential for high returns, commodity ETFs might interest you. ETFs come in various types, each offering unique opportunities. Whether you're into the stock market hustle, prefer the stability of bonds, or want a piece of the commodities pie, there's likely an ETF that fits your needs. So, what type speaks to you and your financial goals? Benefits of investing in ETFs. Diversification advantages. Investing in ETFs, or exchange-traded funds, offers a clear path to diversification. Imagine being able to buy a whole basket of stocks or bonds with just one purchase. That's what an ETF does. Rather than investing all your money into a single stock, you spread the risk across different companies or sectors. This diversity reduces the impact of a poor performance in a single investment on your overall portfolio. For students learning about investing, this is like having a security blanket. You're not putting all your eggs in one basket, which means you can enjoy more of the market's growth while worrying less about individual downturns. ETFs cover various areas of the market. Whether you're interested in tech stocks, healthcare, or even real estate, there's likely an ETF that includes those companies. This broad exposure is a huge plus, especially when you're just starting out and want to explore different sectors. Think of ETFs as a way to build your very own diversified investment buffet, tailored to your interests and risk appetite. Cost effectiveness and expense ratios. One of the biggest perks of investing in ETFs is their cost effectiveness. When you're a student, money can be tight, so every dollar saved counts. ETFs often have lower expense ratios compared to mutual funds. An expense ratio is the annual fee that funds charge their holders. This fee covers operating costs, and because ETFs are passively managed, these costs tend to be lower. This means more money stays in your pocket, allowing your investment to grow more efficiently over time. Moreover, most ETFs come with low or no commission charges when bought through certain platforms. Imagine being able to buy a slice of the stock market without hefty fees eating away at your investment. That's the beauty of ETFs. They provide an affordable way to invest broadly, helping you maximize returns while keeping costs low. For students dreaming of growing their savings, ETFs are a smart choice to consider as they balance affordability with opportunity. Potential risks of ETFs, or exchange-traded funds, have grown in popularity due to their flexibility and diverse investment options. However, like any investment, they come with their set of risks. Understanding these risks can help students make informed decisions when considering them for their portfolio. Let's dive into some of the potential challenges ETFs might present. Market volatility considerations. One of the main attractions of ETFs is their ability to provide exposure to a broad market index. However, this also means that they are susceptible to market volatility. When the overall market takes a hit, ETFs that track it might see their value decrease significantly, which could be a tough lesson for new investors. For instance, during market downturns, the price of an ETF can be just as unpredictable as individual stocks. It's important to remember that while diversification can spread out risk, it doesn't eliminate it entirely. Moreover, because ETFs are traded on major exchanges just like stocks, they can experience price swings throughout the trading day. This intraday volatility might make it harder to predict the exact value of an ETF at any given time, unlike mutual funds, which are priced at the end of the trading day. Students need to be prepared for this aspect of trading if they decide to invest in ETFs. Liquidity and trading risks. Liquidity is a crucial factor. It refers to how easily an asset can be bought or sold in the market without affecting its price. While many ETFs are highly liquid, others, especially those tracking niche or exotic markets, might not be. This lack of liquidity can lead to higher bid-ask spreads, meaning the cost to buy or sell can be higher, impacting your potential returns. Trading risks also come into play with leveraged or inverse ETFs. These are complex products that aim to provide returns that are multiples of the market's performance. They often require a more active trading approach and might not be suitable for students new to investing. Always thoroughly research before diving into these specific types of ETFs. Understanding these risks better prepares you for the real-world fluctuations that come with market investments. Getting started with ETF investments. How to open a brokerage account. Opening a brokerage account is a straightforward process, but choosing the right one sets the stage for your investment journey. First, decide on a reputable brokerage platform. Look for factors like fees, available investment options, and user experience. You often start by filling out an online application. It requires your personal info like your name, address, and social security number. Once approved, you'll link a bank account to transfer funds. Some brokerages may offer promotions for new accounts, so check for those. It's like opening a gateway to the world of investing with just a few clicks. Choosing the right ETFs for you. Picking the right ETFs, or exchange-traded funds, comes down to understanding your goals and risk tolerance. Think about what you want to achieve. Are you saving for retirement or a short-term goal? Next, consider the sectors or industries you believe have potential. Are you interested in tech, healthcare, or green energy? Scan through ETFs to see which ones align with these interests. Each ETF has its mix of assets, so look for diversification. It helps spread risk. Additionally, pay attention to expense ratios. Lower costs can add up to significant savings over time. It's like building a personalized investment bouquet. Understanding ETF tickers and symbols. ETF tickers and symbols are like the nicknames of your ETFs. They're short and unique, making it easy to identify and track your investments. Think of each ticker as an abbreviation. For example, SPY might represent a fund based on the S&P 500 index. When you see these symbols on your brokerage account or financial news ticker, you're seeing the heartbeat of the market. Learning these symbols is part of getting to know your investments better. It's the shorthand language of the stock market and a fun puzzle once you get the hang of it. Strategies for successful ETF investing. Long-term versus short-term strategies. Investing in ETFs, exchange-traded funds, can be like going on a road trip. You need to decide if you're in for a long, scenic journey or a quick, thrilling adventure. Long-term ETF strategies are like slow and steady drives. You invest in ETFs and hold onto them for years. This involves patience and a bit of trust in the market's natural growth over time. It's all about letting your investment grow and compound. You might choose this path if you're thinking about retirement savings or college funds, giving your money a chance to grow without constant supervision. On the flip side, short-term strategies can be exciting, akin to a joyride with constant thrills. This involves more frequent buying and selling, looking to capitalize on short market movements. It's more hands-on and can be a bit risky. The short-term approach might appeal if you enjoy staying up to date with market news and trends, ready to make quick decisions that could boost your returns. Whether you prefer the steady approach or the thrill, ETFs offer flexibility to fit your style. Rebalancing your portfolio. Rebalancing your portfolio is like tuning up your car after a long drive. Over time, as the market moves, some of your investments may grow faster than others, shifting the balance you started with. It's essential to check in periodically and adjust to keep your investments aligned with your goals. Imagine your portfolio as a pie chart. You might want a certain percentage in stocks, bonds, and ETFs. As some parts of your pie grow larger, rebalancing means trimming down the oversized slices and adding to the smaller ones. This helps manage risk and ensures that your investment strategy stays on track. Regular rebalancing can be a key part of maintaining a healthy and robust portfolio, ready to meet your long-term financial goals. It's not just about setting your strategy at the start, but also making sure it evolves with time. ETFs versus mutual funds. A comparative guide, key differences and similarities. Let's dive into the world of ETFs, exchange-traded funds, and mutual funds. Both are investment options that pool money from many investors to buy a variety of stocks, bonds, or other securities. However, they differ in how they are traded and managed. ETFs trade on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day. They often have lower fees because they typically track an index and are passively managed. This setup can make ETFs a cost-effective choice for many investors. On the flip side, mutual funds are usually actively managed. A professional fund manager makes buy and sell decisions aiming to outperform a specific benchmark. You can only buy or sell shares in a mutual fund at the end of the trading day at the calculated net asset value, NAV. The active management often leads to higher fees compared to ETFs. Despite these differences, both ETFs and mutual funds provide diversification, reducing the risk associated with investing in individual stocks or bonds. They also cater to a spectrum of investment goals and risk tolerances, making them flexible choices for investors at any level. When to choose ETFs over mutual funds, you might consider opting for an ETF if you value flexibility and cost savings. If you're keen on trading throughout the day to respond to market movements, or you're looking for a way to round out a specific niche in your portfolio without incurring high fees, ETFs are often the way to go. ETFs can be especially useful for investors looking for tax efficiency. They generally have lower capital gains taxes because of their unique structure, allowing for in-kind redemptions. This tax advantage can lead to better after-tax returns. Ultimately, the choice between ETFs and mutual funds depends on your investment strategy and personal preferences. If lower costs and intraday trading appeal to you, along with an eye on tax implications, ETFs might be your perfect match. However, if you prefer a hands-off approach with the potential benefit of active management, mutual funds could still hold a special place in your portfolio toolbox. Tax implications of ETF investments. Tax efficiency of ETFs. Investing in ETFs can be pretty tax efficient, which is one major reason why they're popular among investors. So, how do ETFs pull this off? Well, ETFs often mimic an index, which means they buy and hold securities rather than actively trading them. This approach keeps taxable events to a minimum since there's less buying and selling within the fund. Unlike mutual funds, which might pass on capital gains to investors frequently, ETFs implement an in-kind creation and redemption process. This process allows them to swap securities with little to no capital gains distribution. It's like having a smart strategy that keeps those taxes in your pocket a bit longer. Capital gains and losses. When you sell your ETF shares, you might end up with capital gains or losses, depending on how the price has changed since you bought them. If you've held the ETF for over a year before selling, any gains are considered long-term, and you'll benefit from a lower tax rate compared to short-term gains. Short-term gains, on the other hand, are taxed like regular income, so keeping your ETF for a bit longer could be financially wise. Now, let's talk about losses. If your ETFs have lost value when you decide to sell, you can use those losses to offset any gains you've made elsewhere. This is called tax loss harvesting, helping you trim down your tax bill. It's essential to keep track of your transactions and consult with a tax professional to maximize these benefits effectively. Understanding these tax implications of ETF investments can give you an edge and help make informed decisions. By taking note of how ETF structures and trading activities can impact your tax situation, you'll be better equipped to manage your investments wisely. It's not just about choosing the right investments, but also understanding how they can fit into your financial plans considering taxes. Whether you're considering ETFs for the first time or looking to optimize your strategy, being tax-savvy is key to capitalizing on your investment journey. Popular ETF providers to consider exploring the world of exchange-traded funds, ETFs, can be fun and rewarding. To get started, it's helpful to know some of the major players in the field. Here's a closer look at 3 popular ETF providers. Vanguard ETFs. Vanguard is a big name in the investment world, known for low-cost options. It's like a favorite brand among many investors who love a good deal. Vanguard offers a wide range of ETFs that cover different markets and sectors. Whether you're into stocks, bonds, or even international markets, there's likely a Vanguard ETF for you. They focus on keeping expenses low, which means more money stays in your pocket. This makes them an excellent choice for students new to investing. iShares and BlackRock ETFs. iShares is another leading ETF provider and is part of BlackRock, one of the largest asset management firms globally. iShares ETFs offer a broad selection, giving you access to virtually any market or industry you can imagine. From technology to green energy, iShares has something for everyone. Their products are designed to be flexible, catering to both beginners and those with more experience. BlackRock, the parent company, brings a wealth of expertise and resources to iShares, ensuring high-quality offerings and innovative solutions. SPDR ETFs. SPDR ETFs are managed by State Street Global Advisors, and they hold a special place in the history of ETFs. SPDR, pronounced SPDR, was the first US-listed ETF, making it a pioneer in the field. They offer a wide variety of options, including the popular SPDR S&AMP P500 ETF, which tracks the S&AMP P500 index. This ETF is often seen as a great pick for those looking to invest in a broad slice of the US stock market. SPDR's approach tends to be straightforward and efficient, appealing to both newbie investors and seasoned professionals. Diving into ETFs by exploring providers like Vanguard, iShares, and SPDR can be an excellent way to learn and grow your investment knowledge. Each offers unique benefits, so it's worth considering your individual goals and preferences as you navigate this exciting financial landscape. ETFs in different markets. International and global ETFs. When you think about investing, keeping all your financial eggs in one basket isn't always the best idea. This is where international and global ETFs come in handy. They are like a passport that lets you invest beyond your home country, tapping into the vast opportunities around the world. International ETFs focus on investments outside of your home country, but within specific regions, like Europe or Asia. On the other hand, global ETFs take it a step further by spreading investments across the entire world, including your home country. These types of ETFs can help diversify your portfolio, making your investments less susceptible to the ups and downs of a single market. For example, when the US market is struggling, markets in other parts of the world might be thriving. By holding international or global ETFs, you can benefit from growth in different markets, balancing out the risks. Emerging market ETFs. Now, let's dive into emerging market ETFs. Imagine investing in booming economies that are not fully developed yet but have great growth potential. That's the focus of emerging market ETFs. They target countries that are experiencing rapid economic growth and industrialization. These countries often include nations like Brazil, China, India, and South Africa, Investing in emerging market ETFs can be a thrilling ride. These markets can offer high returns because developing economies often grow faster than mature ones. However, they also come with higher risks due to factors like political instability, currency fluctuations, and market volatility. Yet, if you're looking to spice up your investment portfolio, emerging market ETFs can add an exciting element. They provide a way to tap into the dynamic growth prospects of emerging economies, potentially offering a lucrative addition to your investments. By including international, global, and emerging market ETFs in your portfolio, you can create a balanced mix that helps you take advantage of market growth, diversify your risks, and explore new investment opportunities across the globe.